Day 40 of my journey to a $500,000 stock market portfolio. So I didn't do much today, closed a few positions, opened a few. So let me go first with the trades that I closed today for a profit. So Trade Desk was a trade that I opened, you could see right over here, December 30th. It was a put spread at a 225 strike expiring January 31st. I opened it when Trade Desk opened one day 6% down or 4% down. So I decided to sell a put spread at 225. I think Trade Desk was trading at around 250 at that time. I went 30 days out, collected $90, and then today, January 2nd, so 2 days, I was able to close it for 50% of the premium that I collected. So close it for $45, so the difference is the profit. I could hold on to it for an extra 28 days and keep the full profit, but it doesn't make sense. If I can achieve 50% in 2 days, then I'm better off closing it in 2 days. I also closed a DIA put spread expiring January 17. So the DIA put spread, I had opened it. Let me just look for it here. January 17, DIA. All right, there it is. DIA, January 17, a put spread at a 279 strike. That's the short strike. So that's the strike that I need the stock to stay above come January 17. So I did this trade. I opened it December 18. And today, January 2nd, I was able to close it for $32. So I opened it for $80, closed it today for $32. So more than 50% profit, but this one was about 2 weeks. I ended up holding it for 2 weeks. And that's because the stock or the price of the stock did not allow me to close it earlier. I also closed Amazon today, so I paid $27 to close it, but I had opened Amazon. So this is Amazon January 24th. So Amazon January 24th expiry, I opened it December 24th, closed it January 2nd, so about a week. I opened it for $89 and I closed it today for $27. So I made more than 50% profit, but that's because Amazon shot up like crazy. My short strike was actually 17.20, so I had a good chance of just leaving it till expiry and collecting full profit. But once again, making more than 50% in 1 week makes more sense to close it. I also opened a trade in IWM and the Qs, a put spread. So the IWM was at 160, short strike, and the Qs was at 205. Collected $50 for the Qs and $65 for IWM, but I'm pretty far from the current market price, so it has a good chance of winning. This one, I'm probably not going to close at 50% because if I close it at 50%, the profit is going to get eaten up by commissions. If I had more contracts, so if I had 2 contracts or 3 contracts, then maybe I can close it for 50%. But right now it's only 1 contract. So if I close this for $25, there's $12 that's going to get lost in commission. So I'm left with nothing. So I'm probably going to let this one go through expiration till January 31st to keep the full $50. And I opened a put spread on the SPY January 31st at a 315 strike, collecting $60. And Costco as well, January 31st at a 280 strike, collecting $60 as well. So I've got 2 put spreads on DIA. I've got 3 put spreads on IWM. I've got 2 put spreads on MasterCard. Actually, one of them is kind of profitable. This one here has a chance. Yeah, this one I could probably close for 50%. It's very close. This one I think I just opened recently, so it's not ready yet. It's showing a profit, but yeah, it's already showing almost a 50% profit actually. This one is probably even ready to be closed. We'll see tomorrow. Probably not if the market opens lower tomorrow, but maybe next week. Netflix, this one's showing a small loss, but my short strike is 300. Netflix is trading at 330. I've got another one on Netflix expiring January 31st at a 290 strike. It's showing a small profit. Now, even though I'm very far from my strike, from the current price, premiums might be higher because we're going into earnings on Netflix. I think Netflix has earnings end of January. and usually premiums around earnings gets higher. So that's probably why the premiums are higher, even though I'm in a good position. I should be able, in any other situation, I would have been able to close this trade already. So expected earnings is January 21st. So that's why these premiums are high. But if after earnings Netflix stays above my strikes, I'll be able to close them easily for 50% or even less. I've got 2 put spreads on the Qs. So one at 208 strike expiring January 24th, and one at a 205 strike expiring January 31st. This one I just opened today. Didn't collect much, but for some reason I felt safer to go further. So I'm less stressed. I don't have to worry about my short strike being breached. I mean, the Qs would have a long way to go before it starts to go below 205. I've got 1, 2, 3, 4, 5, 6 put spreads on the SPY. So that can be dangerous, but all at different expiry dates. The strikes are similar, actually. I've got one at 319, 317, 316, 316, 315, 315. But the SPY today is closed at 325. So, I mean, it looks like it has a good chance, but some of them are showing a small profit. This one here is showing a profit, but I think that's just ridiculous because I opened this December 30th, collected about $80, and it's already trading at 42. Probably not tomorrow because the market looks like it's going to open lower, but maybe next week I'll be able to close these ones, hopefully before anything major happens, because I've got 6 spreads that could get in trouble, although they have different expiry dates. And then I've got 2 put spreads on Tesla, January 24th, January 31st, 375 strike and 370 strike. Now this one is showing a small profit as well. I think I opened this at 75 cents. Yeah, this one is 75 cents or $75. So it's not ready to be closed, but it's getting close. See, this one's showing a $20 profit. I opened this one for $1, I believe. Yeah, $100. And see, I could close it for 80, so it's not ready to be closed yet. Uber decided to move up today. I hope it drops because my strike is at 29.5. So this is similar to the American Airlines covered call. I'm going to have to move it up. And then I've got my United States Steel covered call. Nothing new happened except for the stock dropping even more. And my short strike is 14. My cost is 18. So I'm safe on the call option, but I'm losing money on the stock itself, $3,000 down. I actually want to go straight to my RESP. I did something today I did not want to do, but I felt like it was a good trade, a good probability trade. I bought options. I bought a call option on McDonald's, but I went 2 years out. So this one expires January 21st, 2022. I took a 210 strike. Basically, I had money left over in my RESP when I sold the MDR covered call trade. I had about 1,500 US. So I decided to buy a call option on McDonald's. Why? Because McDonald's is a stock that goes up consistently. If you look at the past year, maybe not the past year, but this was the highest point, and then it dropped. But I'm very confident that in the next 2 years, it'll surpass 222 for sure easily. If you look at the past 3 years, it's always going up. Even if it comes down a little bit, it always goes back up. 5 years, same thing. And even more importantly is, even during the crash, it didn't drop that much. December 2008 or November 2008, it's around $60. And then in 2009, it reached $54 or $54. So during the 2009-2008 crash, the stock went from 62 to 54. That's nothing. So that's why I have a lot of confidence that even if it dropped a little bit since August 2019, it dropped even more after earnings, but pretty confident that in 2 years, I'm giving myself 2 years for this stock to move up a little bit, and then I can sell the call option. Bought it at 14, so I could probably sell it at 18, 16 even. Since I can't afford, I could have just bought McDonald's stock, but I feel like it's gonna take. I'll have to wait for the stock to move a lot to make a decent return. But if I buy the option, the return on capital will be much better. And basically, my break even is 210 plus what I paid. So for me to break even, I need McDonald's to be at 224. So 210 plus 14, so 224, come January 21st, 2022. So I think it's going to be at 300 come January 2022. So that's why I felt confident in buying this call option. Otherwise, I wouldn't do that. And I still have my DFN shares that have dropped a bit. And you've got Bombardier that went up a little bit. In my RSP, nothing really changed. Still have my covered call trades. Novavax went up a little bit from 4 to 450. I needed to go back up to 32. Square went up as well. It's trading at 64 now. In my TFSA, I rolled some call options on Bed Bath & Beyond. Stayed at the same strike of 12. I think I collected about 25 cents or 20 cents. So I'm basically lowering my cost basis on this stock because the best I can get out of it is $12. So if I can just keep collecting premiums out of it, then why not? And I tried to close this trade out and get my money back at $11 since that's my strike here. It didn't go through, but I'm going to try again tomorrow. Grubhub dropped a little bit, so that's good, giving me some breathing room at my 50 strike expiring February 21st. But I know Grubhub can easily move 3 points in one day, so although I'm happy right now, but it could backfire anytime. IMGN dropped as well, so that's good. I needed to drop below 3 come January 17, and NEO as well dropped. I needed to get close to 2.5 come January 17. So I've got some capital right now in my TFSA, some buying power. I've got about 36,000 Canadian or 27,000 US. What I want to do with it is buy some Qs, do a covered call trade on the Qs. But look at this. I was looking at it this morning. It was at 214. It closed the day at 216.45. That's ridiculous. But anyways, if it goes down tomorrow, if it opens down tomorrow, I might get into a covered call trade, and I might do it every week. So for example, if we're at 216 right now, I might go for, let's say, the 215 strike. So in the money strike. What that does is come January 10th, if the Qs is trading above 215, my shares are going to get taken away at 215, but I only paid 214, so my return is 0.4%. But if I'm able to do this 52 weeks in a year, that's 24% a year. Now, what's going to happen is I'm not going to have the same return every week, of course, because what could happen is the Qs could go up, my shares get called away, I'll have to do it again, and if the Qs keep going up, the premiums will go down, and then at some point, let's say I'm at a 216 strike or a 217 strike, the Qs could drop hard to 210, but my cost is 217 or 216, so I don't want to lose my shares, of course, lower than 216, lower than my cost, so I'm going to have to sell a call option at a 216 strike, and what's going to happen is it's going to be a much smaller return. For example, let's say last week I had bought the Qs at 220. Let's say it was trading at 220s, and this week it dropped to 216. So I want to sell call options again for the following week. Now I cannot sell at a 216 strike because I could lose my shares at 216 if the stock is trading above 216 come the next expiry date. So I'm going to have to stay at 220. So if I stay at 220 to be safe, I'm going to be collecting only 27 cents. It's going to be a much smaller return. So 27 divided by, let's say my cost was 220 initially, times 52, that gives me a return of 6% per year. So that's the issue with selling at the money covered calls or in the money covered calls, is that you're not going to be getting the same premiums every week. Another option is to actually sell out of the money. So let's say I'm bullish on the Qs. Let's say the Qs is something I want to hold forever. And it wouldn't be a bad idea, because if you look in the last 5 years, stock went from 108 to 216, almost I think a 13% return every year. So this is something that consistently goes up. So why not hold it forever and take advantage of capital appreciation? So if this is something I want to do, I could buy the Qs, let's say at 216, but then instead of selling at a call option at a 216 strike, I could sell it a bit further, making sure that I've got enough room so that the stock does not surpass my strike. So then I end up keeping the stock and I end up keeping the premium. But of course, in return, I'm getting a smaller premium. If I go to 216 strike, I'll collect a higher premium. but then I miss out on potential capital appreciation. So I have to decide, do I want the capital appreciation or do I want the higher premium right now? So I guess it depends on your strategy. Is your strategy to grow your portfolio, or is your strategy to make income right now? So initially, I want income right now. I want to see what's the most income I could produce with my capital. But if I just go for growth, how can I spend growth? How can I spend capital appreciation? I have to sell the shares in order to spend it. If I sell call options always out of the money, that's considered an income, but it's going to be a small return compared to at the money call options. So that's a trade-off. But let's say I were to sell the 46 cents and the cost is 216. That gives me a return of annually would give me a return of 11%. So this would allow me to take advantage of capital appreciation, but also make a return of 11% per year if I always sell at the money, if I always sell out of the money call options. Now, the stock isn't going to always go up consistently. There's going to be weeks where it's going to drop hard. It might even drop below your initial cost. You're not going to be selling at a strike that's higher than your cost. If the Qs drop to 212, the 219 strike is going to be worthless. So you're going to have to get closer. You might have to go to 216. But then what if the Qs go from 212 to 216 in 1 week and you end up losing your shares at the price that you bought it at? Or you could stay at a 219 strike, but then you're going to have to go 2 weeks or 3 weeks out so that you collect enough premiums. But then obviously the return per year, return on capital, is going to be lower. So that's my dilemma right now with my TFSA is, should I go for buy and hold? Well, I know I want to buy either the Qs or the SPY and do covered calls on them. That I know, but I don't know yet if I want to do out of the money call options or at the money call options, or even in the money call options to get the highest return right now. But I would miss out on capital appreciation. All right, so if you have any questions, any suggestions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.